Welcome to the Deep Dive. Today, we're really getting into something vital: the ethical responsibilities, the rules of the road for professional accountants.
That's right. We're looking at this IESBA document, specifically Part 1.
Yeah, you shared IESBA 1.pdf with us, and, well, the aim here is to pull out the main ideas, the core principles, so you, the listener, can get the key takeaways without, drowning in jargon.
Exactly. Think of it like a roadmap. This first part covers complying with the code itself, then digs into the fundamental principles, and finally there's this conceptual framework, which sort of ties it all together. It's designed to build understanding step by step.
Okay, sounds like a plan. Let's jump into that first bit then, Section 100. Complying with the code. It kicks off saying a huge part of being a professional accountant is acting in the public interest. Why start there? Why is that so foundational?
Well, it really is the bedrock, isn't it? It's all about trust. If you
Really?
think about financial information, people rely on it. So you need confidence that the folks preparing it, auditing it, are acting with integrity.
Right. Trust is everything.
Totally. And the code itself points out, this confidence doesn't just appear. It comes from a commitment to ethics, sure, but also from solid business sense, applying expertise well, and importantly, good professional judgment.
And this code, it's not just like a nice suggestion, is it? It sounds pretty serious, adopted by big accountancy bodies globally, like IFAC.
Oh, absolutely. It sets a high bar. It's meant to be the common standard for ethical behavior across the profession worldwide.
Okay.
And within it, you've got these 5 fundamental principles. We'll get to those in a moment. And this thing called the conceptual framework.
The framework, that sounds like the practical bit.
Yeah, you could say that. It's the system accountants are meant to use to spot potential ethical issues, threats, and figure out how to handle them properly.
Gotcha. Now, I noticed in the documents, some bits have an R next to them, some have an A. What's that about?
Good spot. That's just a way to structure it. R stands for requirement. These are the mandatory bits things an accountant must do. No ifs, ands, or buts.
Okay, R is rule. Must do.
Pretty much. And A is application material. This gives context, guidance, maybe examples. It helps explain the why or how behind the requirement, helps you apply the R sections correctly.
Right, makes sense. So, boiling down Section 100, it's basically saying every accountant has to follow this code, and crucially, they need to understand those fundamental principles, not just know they exist.
Precisely. It's about internalization, not just ticking a box. And actually, the code even encourages accountants, if they're ever unsure about what's right in the public interest, to seek advice, consult colleagues, or their professional body.
That shows a commitment to getting it right, rather than just, well, guessing.
Exactly. It acknowledges that ethical dilemmas aren't always black and white.
The section also mentions laws and regulations. What if those say something different from the code?
Yeah, that's a practical point. Accountants operate under laws too, obviously. The code is clear. If there's a conflict, you follow whichever rule is more stringent, tougher. If the law demands more than the code, follow the law. If the code demands more, follow the code.
So, always the higher standard.
Always the higher standard. It reinforces that ethics is paramount.
And hypothetically, what if someone slips up, breaches the code?
Well, it outlines a process. First, figure out how significant the breach is. What's the impact? Then, you have to take action. Address the consequences. Fix what you can.
And does it stop there?
Not necessarily. Depending on how serious it is, you might need to report the breach maybe to those affected, or your firm, or even the relevant professional or regulatory bodies. It's about accountability.
Okay, that gives a good overview of the why and how of complying. Shall we move on to the principles themselves? Section 110. The fundamental principles, 5 of them, you said.
That's right. 5 core ethical pillars. The first one is integrity.
Integrity. Sounds straightforward.
It means being straightforward and honest. Simple on the surface, but it runs deep. It covers all professional and business relationships.
So not just telling the truth, but
Yeah.
more.
Definitely more. It's about acting appropriately when you face dilemmas, challenging others if you see something wrong, and crucially, not knowingly being associated with reports or information that's false or misleading in a material way. Think about pressure to, cook the books slightly. Integrity means saying no.
Standing firm. Got it. What's number 2?
Objectivity. This is about professional judgment. Making decisions without letting bias or conflicts of interest or someone else's influence compromise that judgment.
So impartiality. Like if you're auditing a company owned by your best friend.
Exactly. That personal relationship could create a bias, or at least the appearance of bias. Objectivity means recognizing that potential influence and making sure it doesn't affect your work, or stepping away if you can't guarantee impartiality.
Hmm. Makes sense. Principle 3.
Professional competence and due care. This is kind of a two-parter.
Okay.
Professional competence means you need to have the right skills and knowledge for the job, and importantly, you need to keep them up to date. Things change fast in accounting, tax laws, regulations.
So lifelong learning, basically.
Pretty much. And the due care part means you have to act diligently, carefully, follow the relevant standards when you're doing your work.
Okay.
It also means knowing your limits. Don't pretend to be an expert in something if you're not. Get help if you need it.
Right. Don't bite off more than you can chew professionally. Number 4.
Confidentiality. This one's huge, obviously. Respecting the privacy of information you get through your professional work.
Client secrets, basically.
Client secrets, employer secrets, yes. You can't just gossip about a client's financial troubles or business plans. And this doesn't end when the job ends either. If you leave a firm, you still can't spill the beans on your old clients.
So it lasts forever.
The duty itself lasts, yes.
Hmm.
But there are exceptions, specific situations where disclosure is allowed or even required.
Like what?
Well, if the law requires it, like a court order, or if your client gives you clear permission, or sometimes there's a professional duty, like cooperating with an ethics investigation by your professional body.
So it's not absolute, but you need a very good reason to break confidentiality.
A very good legally or professionally sanctioned reason, and you need to weigh the factors carefully before deciding to disclose anything.
Okay. And the 5th and final principle?
Professional behavior. This one's a bit broader. It means complying with all the relevant laws and regulations naturally.
Legal basics.
Yes, but also acting in a way that upholds the reputation of the profession. Avoid any conduct that might discredit accountancy.
Like what kind of conduct?
Things like making exaggerated claims about your services and marketing or unfairly rubbishing the work of another accountant. It's about maintaining public trust of the profession as a whole. Acting professionally, basically.
So those 5, integrity, objectivity, competence, and due care, confidentiality, and professional behavior, they're the non-negotiables.
Exactly. Accountants have to comply with all of them. They really are the ethical bedrock.
Right. Which brings us neatly to Section 120, the conceptual framework. You called it a toolkit earlier.
Yeah, that's a good way to think about it. It's the practical process for applying those principles in real life, especially when things get tricky. It helps accountants spot ethical threats, figure out how serious they are, and deal with them.
So how does it actually work? What's the process?
It's essentially a 3-step approach. First, identify threats. What situations or relationships might actually compromise your ability to stick to those 5 fundamental principles?
Okay, spot the danger zone.
Exactly. Second, evaluate the threats you've identified. How significant are they? Are they minor? Or do they pose a real risk to your ethical compliance?
Assess the risk level.
Right. And third, address the threats. Take action to either eliminate the threat completely or reduce it down to what the code calls an acceptable level.
An acceptable level.
Meaning a level where a reasonable and informed third party looking at the situation would likely conclude that your compliance with the principles isn't compromised.
So it's not just about your feeling, but what an objective outsider would think.
Precisely. And the code really hammers home the need to use professional judgment and maintain an inquiring mind. Be skeptical. Ask questions when you're applying this framework. Don't just go through the motions.
You mentioned identifying threats. Does the code give examples of what these threats look like?
It does. It categorizes them into 5 broad types, which is quite helpful.
Okay, let's hear them.
First, there's the self-interest threat. This is where your own financial or other interests could sway your judgment, like owning shares in a company you're auditing or being heavily dependent on fees from one particular client.
Okay, your own interests getting in the way. What's next?
Second, self-review threat. This happens when you might have to review or reevaluate work you or your firm did previously. For instance, if you prepared the accounting records for a client and then you're asked to audit those same records.
Ah, yeah. Hard to be critical of your own work.
Yeah, very hard. Third is the advocacy threat. This is when you're promoting a client's position to the point where your objectivity might be compromised. Maybe you're acting like a salesperson for their shares or representing them in a legal dispute against a third party.
You become too much of a cheerleader.
Kind of, yeah. Fourth is the familiarity threat. This comes from long or close relationships. You might become too sympathetic to the client's interests or too accepting of their work simply because you know them well or have worked with them for ages.
Like the best friend scenario again, but developed over time.
Exactly. And finally, the fifth is the intimidation threat. This is when you're deterred from acting objectively because of actual or perceived pressure.
Like being threatened with dismissal if you don't agree with a certain accounting treatment.
That's a classic example. Or maybe pressure from a dominant personality at the client company.
Okay, so those are the 5 types of threats.
Yes.
Self-interest, self-review, advocacy, familiarity, and intimidation. Once an accountant spots one, how do they figure out, how bad it is? The evaluation step.
They need to weigh it up, considering both qualitative and quantitative factors. Is it a direct threat or indirect? How material is the issue involved? What's the nature of the relationship? It requires judgment based on the specific facts and circumstances.
And if they decide the threat is significant, not at an acceptable level.
Then they have to apply safeguards. These are actions or measures to eliminate the threat or reduce it.
Can you give examples of safeguards?
Sure, they can be created by the profession, legislation, or regulation. Or they can be within the work environment. Think firm-wide safeguards like quality control policies, ethics training, or having whistleblower channels.
Right, things the firm puts in place.
Exactly. Or they could be engagement-specific, like having an independent reviewer check the work, rotating senior staff off an engagement after a certain period, or simply consulting with a third party.
And sometimes the only safeguard is?
Sometimes the threat is just too significant, and no safeguard can adequately reduce it. In that case, the only option might be to decline or end the specific professional activity or engagement, or even resign from the client relationship.
Wow, okay. So it can go that far? The framework also mentions being aware of biases, right? And organizational culture.
Yes, that's an important refinement. When applying the framework, accountants need to be conscious of potential cognitive biases, like confirmation bias, where you favor information confirming your beliefs, or overconfidence bias. The environment within the firm, the organizational culture can also influence how ethically people behave.
So it's not just a mechanical process. You need self-awareness too.
Absolutely. And finally, the section links back strongly to independence, especially for audits and reviews. The conceptual framework is the primary tool used to identify and address threats to independence.
Because for an audit opinion to be credible, the auditor has to be independent.
Has to be, both in mind and appearance. Objectivity and integrity are key components of independence. And professional skepticism, that questioning mind we talked about, is critical when performing audits and reviews.
This has been, well, really illuminating. It paints a picture of a profession that takes its ethical duties very seriously, with a pretty robust system in place.
I think that's fair to say. The overall message from this part of the code is clear. Accountants have a fundamental duty to act in the public interest, and this ethical framework is designed to help them do just that.
And the foundation stones are those 5 principles we walked through: integrity, objectivity, professional competence and due care, confidentiality, and professional behavior.
Couldn't say it better myself. Those are the absolute core.
And the conceptual framework is the practical guide, the map, for navigating the ethical landscape when things aren't straightforward.
Exactly. It provides that structure for identifying, evaluating, and addressing threats to those principles.
So a final thought, perhaps, for you, the listener. As we've unpacked this framework for accountants, maybe consider how these ideas, these principles, the need for objective judgment, dealing with threats and biases, might play out in other fields. Think about doctors, lawyers, engineers, even journalists. Where else is that bedrock of ethical conduct so vital for maintaining public trust? Something to chew on.
A great point. Trust is fragile, and ethical frameworks like this are designed to protect it.
Well, thanks for walking us through that. Really helpful.
My pleasure.